started.
Okay, I've got it set up to record, and I believe we're all here, so you can go ahead and get started. I'm going to mute myself, and then everybody just please remember that when you need to speak, it's going to default to being muted. You'll need to unmute yourself, and then maybe hit mute again to make sure that we're not talking over each other.
Okay. All right, call this meeting to order, the Johnson County Sheriff's Merit Board. We'll first go to the Pension Board. I believe Stan and I think Elaine's on there too, right? Okay, so Stan, if you want to go ahead and go through the report, please.
Okay, can everybody hear me okay?
Yes.
Yes.
Okay, I think Brandy sent around the actuarial report we did earlier this month. So everybody should have a copy of that. She sent it this morning. And we'll just, I don't think I can share it, so I'm gonna go away on the screen, I think, and just go through this pretty quickly. If you go to page 5 of the report, there we show what the approved budgeted amount is for. Oops, I think she sent around the wrong report. I'm looking at the 2019.
If you want
I
to,
think that may have happened.
I can set you up to share your screen if you want to do that. If you've got it on the device that you're doing Zoom on, I can change it so you can do that if you'd like.
Yeah, let me dig it up here. Pretty sure I have it. Yeah, I didn't even notice that when she sent that around this morning that it was last year's. So
You have a text message.
okay.
Okay, I've got you set up as the host. I think that's all I need to do to allow you. You should have a share screen button then
Okay, let me.
down at the bottom if you're on desktop.
Yeah, I'm on an iPad, so
I'm not sure where it's at on an iPad, but there should be a share screen wherever you can.
Right
view
about in the
participants
middle.
Chat.
there we go. Okay, so I just have to have it open.
I believe so. Yeah,
Okay.
your video is not showing right now, so it'll. If you okay, your video's back on now.
Okay, so share content, and then if I go to the screen, maybe. Let's see. Sorry about that.
That's all right. And if you can't get it to work, alternatively, you could email it to me real quick, and I'll share it on mine so that everybody can see it.
Okay, what's your what's your email?
It's A Barnhart, ABARNHART at co.johnson.in.us. And then do me a favor, and you're gonna have to make me the host again. I had to switch you to the host to screen share, so you'll have to click on me and click the button that says make me a host.
Okay. Participants. Okay.
Hey, Bill, he's on it too.
Should have the email, I think.
I've got the email. Okay, yeah, okay. You've got me back as the host. Oh, okay. Give me just a second now. Get the right one. Okay, there we go. Is everybody seeing it?
Yes.
Yes.
Okay, I'm gonna pull mine my own copy up, I think. And so, so yeah, that's the 1/1/2020 actuarial report. Determines the 2021 budget number. So we used all information as of the end of 2019. If you go to page 4, or excuse me, page 5, there we show the 2020 approved budgeted amount and that was determined a year ago at 1/1/19. And so the budget number in the county's budget was 901,000. And then there's an additional 80,759 that's going to come from the service or process fees and so forth to in order for the plan to meet the minimum funding requirements for 2020. Okay.
Okay.
Go to page 7. Here we show 3 contributions. Now for 2021, there's a range. The key is to at least meet the minimum funding requirements for 2021, just like past years. And that number is up to a little over 1.13 million, about 33.9% of pay. We've given you a range where you could, do the recommended contribution, or even what we're terming the accelerated funding contribution. All 3 are perfectly fine to do. The key is to meet the minimum that's shown on the bottom number. Let's go to page 13. Shows breakdown of demographic head counts, up 1 active participant to 56 compared to the prior year, about the same number of retirees. And there's an exhibit later in the report that shows, how these numbers from the beginning of the year to the end of 2019 reconcile. Reported salaries are up from 3.1 million to about 3.34 million. You've got a couple active participants, or got 1 in drop and 2 active participants who are past normal retirement age. Next page 14. This is the exhibit where we determine or we calculate what the actuarial value of assets are, gains and losses on the assets that occur each year. And by gains, I mean earnings in excess, trust earnings in excess of the 6 3/4. A loss if the trust earnings were less than the 6 3/4. So you're gonna have gains and losses in each year unless you hit the 6 3/4 exactly right. Those gains and losses are phased in 20% at a time. And so it's a rolling 5-year average smoothing method here on the assets. You can see on this page that in 2019, there was a gain of almost $1.36 million. That's on line 9. And so, what happens is the plan got to recognize 20% of that in this calculation. And then there's still 80% left to be recognized the next 4 years. So what this does is help smooth out contribution volatility as much as possible by recognizing the gains and losses over a longer period of time than just the year they occur. If you go to the next page 15 summarizes what actually happened in the trust during 2019. The year started at a little over 13.1 million in assets, ended at almost 14.2. And when you factor in the county contribution for 2019, that the majority of it that went in after the end of the year, based off of timing on when it was received by the trust and posted, the assets were at about 15 million to end last year. Now, Janet and Elaine will talk a little bit about assets for this year, but you had a really good year last year in the trust for the retirement plan. The rate of return was, and we'll get to this in a little bit, but it was a little over 17.8%. for 2019. So we're assuming 6 3/4. So you exceeded that by 11%. So, you know, solid year on the assets last year. If you go to page 16, here we show, we track the status on what the minimum required contribution was for the retirement plan. That's column number 1 versus what actually went in to the trust. That's column number 2. And then the ratio of those 2 numbers. The key is the state statute wants these plans to be funded at least the minimum, and you get into some issues if you fail to do that over a period of time. And so you guys haven't had that issue. That's, you know, that's a good thing. Next, page 17. On the basis that governmental retirement and pension plans get measured as far as a funded status, your plan's about 70.6% funded as of the end of 2019. It's been fluctuating, you know, in the 70s. You can see this range here, you know, from 70 to, you know, 75, 76 for the last 10 or so years. And, you know, PERF is in the mid 80s in terms of funded percentage. We'd like to see, you know, this number be a little bit higher, but it's, you know, there are several county police plans and other local governmental plans that are, you know, in your range. So this isn't a huge concern because this is a long-term entity, and, you know, over time the contribution pattern and the investment earnings should help move that percentage up. Okay. The next few pages are on the supplemental benefit plan, which is the plan that has disability and death benefits for spouses and dependent kids. About 1.1% of payroll is the contribution amount here. Trust is paying out $14,400 in benefits from the benefit plan. Again, this is on page 18. Page 20 again shows the assets and the smoothing technique that's used to phase in the gains and losses. I didn't point this out, but it's the same concept. The line item number 14 on this page 20 shows a ratio of the actuarial value to the real market value. And when that percentage is below 100%, what that means here is that these last 5 years have resulted in a smooth value that, you know, you've had gains, just a little bit of net gain over the last 5 years to push that ratio below 100%. So, you know, that's not a bad thing. You want to be as close to 100% on that number as you can. When you're below 100%, that's, you know, even a little bit better. And so, you know, that there isn't anything you guys can do to drive that number. It's all based off of gains and losses on what the trust does. I think the number for the retirement plan was in around 99% as well. Let's see, it was back on page, yeah, it was 99.07 back on page 14. All right, benefit plan, we give you one number for the contribution. So page 22 shows 100% of the minimum has always gone in. Benefit plan is over 100% funded on page 23. So, you know, that's a good thing. So basically you're just paying for the group term life and disability insurance premiums plus any administrative expenses for the most part each year. Page 24 gives that summary of the demographic data. You didn't have anybody retire from active status during 2019. You added one new deputy, and then you had one of the retirees passed away, and their spouse or their beneficiary is receiving payments as a beneficiary. So not a lot of activity there. Next, page 25 shows the average age and service of the active group. Relatively young group at 43.8 on the average age, 12.4 on the service. Page 26 is always a good exhibit. I know Janet and Elaine pay attention to this exhibit out of our report. This is a payout projection on what the retirement plan is projected to pay out each year over the next 10. It doesn't work out exactly that, you know, you're going to have 13 people retire in 2021 and start payments, and, you know, 5 people in 2028, but this gives you an idea what the trend is. So you're going from paying $900,000 in pension benefits to, you know, potentially $1,650,000 if your retirement pattern kind of follows what's expected. That's important because this exhibit is important because of cash flow issues in the plan. You want to make sure you have liquid assets and aren't selling assets to be able to pay benefits. So this is an important exhibit that all investment managers pay attention to. The next page on 27 shows that 17.8% rate of return from the market perspective during 2019. And we have a 4% salary scale increase assumption, and you exceeded that up to 4.91 was the salaries when you compare 2020's approved salary plus longevity versus the same number from 2019. The next few pages from 28 through 31 show the contribution history from the county's perspective. These are all county contributions. And, you can see in total, the retirement plan on retirement benefit plan contributions on page 31 last year totaled over $944,000. Pages 32 through 37, I won't hit these a whole lot, but they generally talk about risk in a pension plan. What are the risks? The investment risk there at the bottom of page 32, that's one of the two big ones. And probably the primary one is then long-term investment rate of return. What's the risk on, not meeting that? Mortality on the next page, or longevity. Are people living longer now? That's what the tables say. Life expectancy has dialed back a tad in the last couple of years. These studies come out every year on mortality. And so these plans are subject to the longevity risk. The next few pages, 35, shows a summary of what the results would look like if you had a different asset rate of return assumption. 6 3/4 is what PERF uses. It's what we use for the state police. Almost every county police plan uses 6 3/4, and all county police plans that we work on, which are 91 of them, use a rate that's 6 3/4 or lower. So that's a reasonable assumption. If we were using 7 3/4, shown on page 35, the county contribution funding rate would be slightly over 24.5% of pay instead of 32.8. But we're looking out for the long-term health of the plan, and using a 7 3/4 assumption would be just way too aggressive and hurt the plan's funded status in the long haul. So that's the point of that exhibit. The next couple pages, 36 and 37, show some history on some of the important items that get measured for risk and other factors. Retirement plans on 36, benefit plans on 37. The other assumptions start on page 39. We're using, as I mentioned earlier, a 4% salary scale assumption. For retirement purposes, If you, we assume that if you qualify for the special early retirement provision that's in the plan, of getting to age 52 by December 31 of 2022, that you would retire under that provision. Otherwise, we assume people work until normal retirement age, which is age 55. For most deputies, it's 55 and 10 years if you were hired recently. The next page, 40, has the mortality assumptions that we've used the last 2 years. There was a new mortality table issued and finalized in 2019 that specifically looked at public pension plans, and they did studies on mortality studies on general employees, teachers, and hazardous duty / public safety. And so we are using the public safety mortality table that was issued, and that's pretty going to be pretty standard going forward. PERF has indicated they're using that for the 77 police and fire, and we will be using it for the state police this year as well. Pages 42 through 44 or 45, excuse me, have just a summary of the plan provisions from the retirement plan, and then 45 is on the benefit plan. And so, that's sort of the highlights here. I know I went through this pretty fast. Any questions from anybody?
I don't believe so. Any questions from the merit board members?
Well, I guess I would start by thank you for the presentation. I appreciate that. Just from a professional opinion, I mean, just an overall view of the plan, obviously, how do you feel about how things are looking, and obviously with the way market conditions are and things like that, are there going to be any specific changes? Or are we just going to continue as is, or how do things look to you?
I'll let Elaine and Janet talk on the asset side. From our perspective, I mentioned, this plan's a little bit over 70% funded.
Yeah.
It's nice to be making some progress on that, and the county puts in more than the minimum with the service of process fees plus the budgeted amount. Maybe being able to eke that upward a little bit to what we're calling the accelerated contribution. What we show are three contributions, and basically what they involve are, it's like you have the accelerated is paying off a loan over a 15-year period. The loan in this case is the plan's unfunded actuarial liability. The minimum is based off of paying it off over a 25-year period. So that's if you can get it to where you're working off the accelerated number, in the long haul, you save a lot of interest.
Yeah.
By getting that money in faster. But we know,
what's that gap, Stan, from where we are to where we need to be?
You're not going to get to 100% funded, and you don't have to be on this basis. I think the short-term goal in the next 5 years or so would try to get that funded percentage to 80%.
And what's that dollar amount in a round number?
Let me pull this back up. Oops. Let's go. Right now it's on page, funded status is on page 17. So you're 70.6% funded. If right now, if you were 80%, if you wanted to have been at 80% funded, the assets would have needed to have been about 16.8 million. So you were $2 million in assets short of being 80% funded. So, you're if you divided that by 5, you're looking at putting in an extra $400,000 a year on top of whatever you put in now. Probably, gets you pretty close, assuming the other assumptions, get met.
Yeah, but then those assumptions change if we start having deteriorating market conditions, right?
The 6 3/4, that's a long-term assumption.
Okay.
And so we don't necessarily get into, 1 or 2 year look at it. Doesn't, cause us to make adjustments on that. We monitor it, but it used to be 7%, and that was lowered back in 2013 or 14. So, yeah, so, a bad year isn't going to cause, us to drop the assumption, 100 basis points.
Okay.
Even if the time came where, we're just saying, the fixed income rates, the fixed income earnings are just so low that, you almost have to be all in on the equity side to do the 6 3/4. Then
Yeah.
we, would maybe look at it. Even then, it's going to be small movements in the assumption. It's not going to be huge all at once. So that's kind of my take is, we're going to, over the next 5 to, 8 years, it'd be nice to make enough progress to get that number up to 80% funded.
Okay. Thank you, Stan.
Yep.
Any other questions from the board? Those are good questions, Josh.
Yeah.
Anything else? Okay, if not, Elaine, do you have something you want to add?
Yeah, I was going to kind of go a little further as far as to illustrate when Stan talks about the possibility or the need to perhaps lower the interest rate used to calculate the plan cost. In that latter part of the report that starts on, I don't know, page 32, 33, or 34, it does have what if the plan assumption was only 5 3/4 right now, which would be a full percentage point, and that's a significant amount. But if you could pull up that page, it really has a very drastic change in the contribution needs and the funded status if something like that were to occur in the actuarial assumptions. I don't have the numbers in front of me, but it's significant. Would you agree with that, Stan?
Yeah, it absolutely is. And that we show it just for a purpose of, the what if scenario, and we have to show it in the GASB report. And, that's a big movement, 100 basis point all at once. That's likely not how, we would, try to make it work, because it's such a huge hit, out of the blue.
Right, and because it is for the long-term perspective on this plan, it would take the county contribution up to 42% of payroll, where it's now at 32%. I mean, it's a big change.
Yeah,
So, yeah, keeping your mind focused on long terms, this is what the goal is. Short terms, we have to be able to weather that. So, okay, yeah, if you wouldn't mind then, there were 2 pieces that were sent to you folks from us, or from the sheriff, of course, or Brandy there, but that 2 different reports that we prepared. And one of them is the actuarial allocation review. And what we do there is, the report that Stan prepared has, or his firm has, a lot of information, and it's used by a lot of different folks for different reporting. And what we have chosen to do in this presentation, that's just a 7-pager, is to pull out what's really important when it comes to what we're doing. So if you could look at that one on the front page, it has the actuarial and allocation review. Do you have that? Everybody have a copy of that?
Do you want me to share the screen and put it up here?
Yeah,
Everyone?
that'd be good if you could.
Yeah,
Okay.
that'd be great. Can
Okay.
you
Bear with me here.
take over the ownership of it there, Janet?
I think
Of the
so. Let
meeting.
me try here. Hang on. Okay. Do you see the report?
Yes.
Okay.
Yes.
Yeah, that's great. Okay, great. Well, we'll just go ahead and soldier on here, first page. Again, and until today, I didn't realize that Stan was going to be here, but he's gone in detail over the report. And here's then just some of the things that we call like an executive summary for what we're doing. Looking again, of course, he mentioned the change in demographics, that there's one more active participant, and not much change in those that are drawing. Average age of the participant from last year to this year changed just ever so slightly. The new person might have been a youngster. And the average service has just advanced a bit. The recommended county contributions from 19 to 20, and again, as Stan said, that's not the minimum contribution, that's the recommended, based on, I think, what is that, 20-year funding of the plans unfunded.
Right.
A little bit of an uptick there, and as a percentage of payroll went from 31.7 up to 33%. We also show the funded ratio of the retirement plan. We've just had that discussion. And we also then want to point out the in market basis return on the assets of 17.8. So just as a nutshell there, or again, executive summary. Next page, Janet, please. When looking at a whole page full of numbers, I'm kind of a visual person that I really do like how we can have a picture that's just showing how it's accelerated or how it's increased back since 2001. Now, this is just the minimum required contribution, where it was back in 2001 and where it is now for the 2021 budget that the sheriff and chief will be preparing here shortly. And it's just marched forward. What is good to note, though, is that as a percentage of payroll, it has remained pretty level in the 20s, upper 20s, and ticking up just a bit for the year 2021. But that, again, it would be expected. That's why relating things to a percentage of payroll is pretty meaningful, because if you're going to increase the size of your department or your agency, same percentage of payroll means you're going to need a lot more dollars, but in terms of percentage of payroll, you're going to stay pretty level. So if the next page then, please, Janet. This is where Stan even commented that the looking out the next 10 years, what is possible for the distributions that are going to be needed for those who separate and retire. And so we've got a lot on this page. We again have the gold bars showing what it's been historically from 11 up till current, that being in the gray bar there. And then looking forward. Now, the gold bars are the ones that are from this year's report that Stan walked through and presented to you. And what we did this year is we wanted to also do an overlay of what was it last year, when the valuation was prepared, how closely does it follow those trends of what's expected there. You can see a little bit of a change, and part of that is because people are pushing out their retirement. From that exhibit, I believe there were about 13 folks who could walk out the door right now and start drawing a benefit without any reduction. But they're not, they're sticking around. And so the plan is anticipating, be prepared, they could go out. But as they then delay, it pushes out their actual commencement date. So you see that big bump kind of moving forward a bit. You've also got a drop participant in there that somebody's going to be getting a little bit of a bump there as well. As Stan had commented on, contributions to the plan, they've met or exceeded the minimum, most certainly true. One thing I think that you asked Josh about, what could we do to maybe, inch up that percentage funded? As you noticed on the exhibit where it showed when the payments were made, they are coming very late in the year. And if the county is sending the service of process money, but the lion's share that's coming from the budgeted portion is coming late in the year. And there are certainly some counties that feel more comfortable holding on to that cash until late in the year. But if that could be sent a little sooner in the year, most certainly quarterly or something, it would help. Because one of the things I think, Stan, please correct me if I'm wrong here, but you're not anticipating that the contributions are coming in late in December to be posted the first of the next year, when you're looking at the stream of payments expected for the contributions.
Right. Yeah. I mean, that's
Yeah.
exactly right. And, you know, you would confirm this also, Elaine, that there have been a lot of counties decide to, you know, kind of split it up into either fourths or do it, you know, bi-yearly, semi-annually, whatever. You know, you never know, but over the long haul, it's probably going to work to your favor to get the money in earlier.
Right. Dollar cost averaging. I don't know if you've ever heard those phrases where it's like, it's just, you're not likely to be able to time the market on any one day, but if you do it more frequently, it helps. So that's something that maybe could be discussed with your county. The county contributions for the benefit plan, of course, much smaller amount, and they've been, you know, sticking around at that range of about 40,000 for 19 and 20. Stan showed for 21, it's going to be a little bit lower amount, which is always good news as well. Okay, so if I could go to the next page 5. And so this is where that overlay of the health of the plan is illustrated on like a mountain chart here. The gold being the assets, the gray bar on top of that being where the accrued liabilities are. And just like it had been seen in the exhibit, it's about 70%. You know, things have kind of trickled along and not been able to really close that gap to significant. Then the line shows that it's stayed around about the same percentage in terms of funded ratios. It's still a good plan. It's not poorly funded, but true, it would be better if it could be about 80% or north of that. But maintaining where you are is certainly not a bad place to be at all.
And Elaine, I would add also one thing from our perspective on that. That's a good, you know, chart there to see how it's things have sort of held steady during that time frame from 2009 to 2020. The Society of Actuaries has put out 2 major mortality table improvements, and so those have been recognized during that time frame. One was in 2014. And then one less so last year, but it still had improvement. So we're using modern mortality tables, and there's been a couple, you know, rough years where right around 0 on the rates of return, and you still held pretty steady, you know, on the funded percentage. So going forward, there's not going to be the big mortality improvement, we don't believe, when the next round of tables come out. And so that's where, you know, maybe the next 5 to 8 years you can make some, you know, headway on cutting that deficit.
Mm-hmm. Yeah, and I think just to kind of give a reference to what Stan was talking about, the old mortality tables were the 1984, and then when they've been revised, when he says they're better, well, they're more realistic because people are living longer. And so it's better for the people, I guess, or for the public, but not necessarily for a plan that had been funding with an expectation that they wouldn't have lasted as long or lived as long to draw those benefits. Am I too far off on that, Stan?
No, that's exactly right.
Okay. I thought, okay. Okay, so then the next page, this really now kind of dives into where Janet's going to launch. Looking then at, this is the information. We haven't seen anything that has deviated from what we thought would be happening. The plan's following along as expected. So, and then Janet, you want to talk about the allocation?
Sure. I think, you know, what we look for here, realizing that, you know, it's gone down 0.3% as far as the expected return for this allocation. We don't believe that warrants taking on additional risk at this time. We do feel like we can get closer to the 6.75 over longer periods of time by using active managers to gain alpha, by rebalancing. And I'm going to talk a little bit more about all of these tools we have at the ready to kind of improve those returns. But it is one of the things that we like to look at each year when the valuation report comes out is, in light of all of that, should we be making changes to the asset allocation? So if we were to make changes, the direction would be to take on more equity risk, which we're not advising at this point. I think that from a long-term perspective, this mix is still more than appropriate for the plans.
Okay. Sounds good. Anything else?
So I do have a market review. I'm not sure, I didn't see an agenda, so I'm not sure if that's part of it. If I can.
No, you're good. Go ahead. Go ahead.
Okay. Okay, hang on. Let me get to that. Okay. So this was a presentation that we actually sent in late April as kind of try to be a little proactive in what was happening in the markets at the time. I just looked while Elaine was talking, and the last time we were together was February 19th. And so our topic then was what the markets had done in 2019 and what our forecast was going forward. And if you recall, we did mention that we felt like things were going to be more volatile and a lot more challenging to earn the same returns that we've been earning historically. What we didn't know was, 10 days later or less, I guess, would be sort of the breaking point of the markets.
Yes.
So we did put together this summary of what was happening in the first quarter. I'm not going to go through every single page. You can read the bullets and it's pretty descriptive, but I do want to just talk a little bit about the first quarter. Obviously, we know through March 31st, the S&P 500 was down almost 20%. Small caps and internationals were even worse, returning in the quarter, and that basically ended the longest bull market that we'd experienced in U.S. history. Bond returns were positive for the quarter. So when, it was essentially a risk off type market. So there was a flight to quality, which helps bond returns. A lot has happened since March 31st. I'll just say since that time, the S&P has rebounded 13% from the bottom here, this quarter end.
Right.
With small caps and internationals also rebounding. So we're kind of looking at almost the worst point in the market snapshot here. So we have lots of graphs that kind of break the market up through, value versus growth and fixed income, and I won't get into all of those today. One thing, and even since we've printed this in April, this is still dated, but one of the things that I like to show here is that the Fed response, the policy response to what was happening in the markets was much faster and much greater than we saw in the financial crisis of 2009. So they were much more eager to jump in and help support markets, keeping things afloat and making sure that trading was efficient and mortgages were healthy. So from that standpoint, we kind of took some comfort in what was happening to prop the markets up. Again, we've seen more stimulus since even this page was put together, and we'll probably be seeing many more, in the coming months. So our outlook still is in line with what we wrote in April. I think that we are in for more likely a U-shaped type recovery where we've had a steep drop in the economy. I don't think that we're going to see a sharp rebound. I think the consensus now is that until we see a vaccine, the markets are probably going to be slow to recover, especially certain industries like travel, airlines, entertainment. Those industries will be impaired for a long time to come. So unfortunately, consensus is a decline in GDP of between 20 to 40% on an annualized basis. So definitely in recessionary territory. Long term, we do think that, businesses will recover, that people will start reinvesting at some point. And, just a reminder, as markets contract, that's where new businesses and new innovation tends to develop. So there will be more opportunities for investment in those types of companies going forward. Looking for positive notes there.
Okay.
Okay. So just to kind of get through where you are today. So when we sent your quarterly report, your portfolio was actually down about 14%. You can see most of that was an equity negative 22.7% return. So since the March 31st report, the April 1st to last night's close, the portfolio has rebounded 9% of that. So that's a good rebound that we've seen. Year to date, as of yesterday, the portfolio is still down about 7%, 6.8%. So we're seeing that's pretty consistent with our other sheriff's plans, anywhere between 6 to 8% on the negative side. Your allocation is a tick or a little heavier allocated towards equities, so you're on the higher end of that, but we also expect a stronger recovery as equities recover. And then I'll point out one other thing, with the inception to date, which is almost a 1 year period of time, is negative 2.6. So in light of everything that's happened since February 19th and the drastic market drop, the portfolio is down just slightly at 2.6% for the year. Are there any questions with this page before I move on?
I don't believe so. Any questions from the board?
Okay, so oftentimes, when we have markets that are, sharply dropping like that, as a Merit board member, as an investor, the question is, what should we be doing about that? And the response is, we've already done a lot to mitigate those types of risks in the portfolio. So we know that we have to weather short-term volatility in order to earn greater returns over the long term. There's no free lunch, so you have to be able to weather that. We've got tools in place, however, to help us in keeping that long-term perspective. So we would say that it's not a matter of, it is a matter of how we respond, not whether we respond, and we've already put a lot of that work into play before the markets even declined in February. Our game plan during severe market conditions, again, this is just to point out that there is activity going on. Gelser immediately and still continues to monitor the markets for liquidity, making sure that trading is efficient. We still are looking, at the support coming to prop the markets and keep things healthy. We'll definitely notify the committee if there are any concerns we have with executing the investment policy statement. But we are operating in accordance with that document. We've been rebalancing, so as the markets decline, that's an opportunity for us to sell bonds and buy more stocks. So we're buying low and selling high, which is the positive investment practice. And then we will also determine whether to rebalance to minimum ranges or maximum, which right now we're sitting just slightly below our target. Your charge is to stay the course, avoid reactionary decisions, follow the guidance in the investment policy statement, and then communicate to us any changes that we may not be aware of. I'll just review a couple of things that we've put in place. One, we have diversified the portfolio. So when you see the stock markets in the news, 65% of your portfolio is invested in stocks, but you have another 35% in other asset classes. We need to remember that. We're at a 2.6% 1-year loss. And when we selected our allocation, our stress test scenario is a negative 14% annual return. So there could be a worst case where we're sitting here a year from now and looking at a minus 14. Again, that's all part of the expected return assumptions that we've put into place for long-term 6.75% average annualized returns. So while that was uncomfortable to see those negative numbers in the portfolio, it wasn't unexpected as far as our modeling has gone. This just points out as if you have bonds in your portfolio and you spend, so we're paying retirement benefits from the assets, the time to recovery is much greater when markets do rebound. So that's why we have different asset classes in, and we're not looking at only equities in your portfolio. We're looking at the whole thing together. I think we've talked about the smoothing rules as far as the actuarial valuation. So if we do experience a large loss when we meet at December 31st, let's say the market is down 20%, the next time we're looking at your assets, those losses are not assumed as far as the actuarial valuation goes for a full 5 years. So 20% of that is included in the first year, and the loss accumulates over that 5-year period of time. So this is a mechanism that you have in your actuarial valuation that allows you to take more short-term volatility in the portfolio. And we need to rely on that when we have the short-term volatility. So it's doing what we expect it to do. You have a long time horizon, so we can weather this, as I've mentioned. And we also have a number of other asset classes from which we can spend. So when markets are down, we don't have to sell our stocks. We've got plenty in cash and bonds to pay the benefits for a long time to come. And then finally, we take this opportunity, as I mentioned, to rebalance the portfolio. And if you can follow a disciplined rebalancing strategy, it will add value to your overall return. And that is what we've been doing. We've been rebalancing primarily in phases, not trying to hit the exact low, but we have been rebalancing, I believe, 2 times for your portfolio, specifically to get back to the minimum value, as well as making some tactical changes in the sub-asset classes to take advantage of underpriced securities. So when we met in February, we were looking at how it's going to be hard to achieve a 6.75% return going forward. As equity markets have receded, we now have a better prospect of hitting that return. So we've got some opportunity now as long as we stay disciplined with our long-term strategy. Again, this is kind of summarizes what we've done. We've added to domestic and international and non-traditional. We've taken away from bonds to rebalance the portfolio and some of the other repositioning going on. So I just wanted to give you that update to note so you realize that, you know, lots been going on, and we've been seeing a lot of opportunities that we've been able to take advantage of. So.
Okay. All right. Thank you, Janet. Any questions from the board members on Janet's presentation? Or Elaine's? Okay, so I guess we're just going to kind of stay the course.
Yep.
Okay.
For now. Mm-hmm.
Okay, anything else from the board for Stan or for Elaine or for Janet?
No, thank you for the presentation.
Yeah,
Appreciate it.
appreciate it. Thank you very much. I would
Thanks.
ask this question while I got everybody here, and this is for Josh too. How does is there going to be a chance the county could put that money in sooner than they have in the past?
Oh, that'd be a question, I assume, for the auditor's office, and I could talk to Amy and Pam about that. I would guess, and I don't know. I don't know what the circumstances are on how that money is deposited and when. So that would be a good question to ask. I'd like to know that myself.
Okay, so that'd be a question for the auditor to approach her with, right?
I would assume so. Yes.
Okay. All right. Okay. Thank you, guys.
I'll check into that and report back on that.
Okay. Appreciate it, Josh. Thanks.
Oh,
Okay. Thank you. So Stan, Janet, and Elaine, if you're done, you can.
Sure.
well, good, because I
Excellent.
kind of lost you guys. I don't know. Okay.
Hopefully we see each other in person next time, but I appreciate
Yeah,
your time. Thank you.
August 19th.
Okay.
That's the day. We'll be
Sounds
here.
great.
Thank you.
Okay.
Bye-bye.
Thanks.
Thanks,
Bye-bye.
everybody. Thanks, everybody.
Okay. So let's go ahead with the regular merit board meeting, May 20th, 2020. I believe everybody's here, correct? Josh, Angie, Megan, Bob, me, we're all here. Bob's here, right?
Bob, you there?
Bobby?
You might be muted, Bob.
He probably had lunch at Lotus Garden today, and he's probably,
I'm sure he's playing golf, probably.
yeah, it could be too. Are you there, Bob? See if you can find your grandson or granddaughter to help you with this.
I've got him on the screen as well. It
I
looks
don't
like he's connecting to audio, it looks like.
I think he's calling in. It looks like to be able to, it says it's doing something with audio. Or maybe it's on the phone. I'm not sure. I apologize. Everybody had some technical difficulties. The county internet, I think everybody went down there for a minute. I had to connect on the phone, and then but it looks like everything's still recording and we're still good to go. So
Okay. Well, we'll go ahead. Hopefully Bob can hear us, or at least get on there soon. So I got a copy of the minutes. Everybody got a copy of the minutes? And I looked at it, Sheriff. Is there supposed to be a page 2 on this that was sent to us? Because the last sentence says Chief Deputy Barnhart, and it's done.
I'm looking. Let me go through it. I've got all of Brandy's stuff here, and I know that there's some stuff that I need to have Josh and you sign as well.
Okay, we can try to come sometime. But I was just going through the minutes, and it looks like it's kind of cut off there. I didn't know if there was a page 2 or, because what I was sent just said page 1 of 1. Does everybody else have a copy of that?
Yeah, I know what you're talking about. I don't know if it cuts off or if that's just saying that.
Yeah. Angie, do you have a copy of that?
I have a copy and mine's the same way. It looks like it has Barnhart at the end and like it should continue, but it doesn't.
Okay.
Mine's the same way.
Okay.
What I can do is I can give me. I can get them back out to you. Brandy was scanning those in for me, and it's just I don't do many of the Zoom meetings that we're heading up, but we can make sure that you have everything.
Want to make them, want to go ahead and approve them, and then if there's a change to them, we can revise.
Yeah, we can do that. So if you ever had a chance to look at the minutes, I'll take a motion to approve the minutes.
So move.
I'll motion.
Okay, I have a motion to accept the minutes. All those in favor say aye.
Aye.
Everybody say aye. Okay.
Aye.
Aye. Sorry, my
Raise
mute was
your right-
turned on.
That's all right. That's all right.
Usually you're the right-hand guy, Jim.
I know. It's true.
You can't see me. I'm raising my left hand.
Okay. All right, so it passes 5-0. I think I might have heard Bob. Anyway, okay, any new business, Sheriff?
No, Andy's worked very hard. Chief Barnhart has on all of the SOPs. I think we're to a point where the attorney and everybody has those. We're on track. Andy, you want to add to anything that?
Yeah, I'll try to be brief, which isn't one of my well-known qualities, but I sent out a link to view the policies, almost 200 pages of them, to give everybody a chance if they wanted to have any input. I spoke at length with Bill Barrett as our attorney about the some of the issues in there, specifically in the merit board section that has been updated now. If you go to that link as a live document, you can look at it again, or if anybody wants, they can just request. I'll send it to them in PDF or Word format. But in the discussions with it in the past, the rules and regulations of the department had been separated into merit board rules and regs, and then just sort of regular rules and regs, and they had been signed off on in the past by the merit board members. Speaking with Bill Barrett, he said that's not actually a legal requirement in any way. So what we would like to do is, obviously, as I said in my email, the merit board would be the ones that would take action on these if the sheriff brought somebody for disciplinary hearing beyond the 15-day suspension. So wanted to give you guys a chance for any input you might have. If there is none, what we'd like to do is enact these starting today and go forward from this point then. And then as changes come, we'll just push those out to you so you guys are aware of them. It should be a much simpler method of doing it. So that was one of the goals, and then updating a lot of very outdated ones. So that's the goal. If anybody has any questions or ideas, concerns about it.
Okay, did everybody get a chance to look at any of the SOPs?
I did skim through it. I thought it looked good with the knowledge I have, and I know that was a lot of work for sure for you. So
No, I'm sure it was.
a lot.
Yeah. Anybody, Josh, anything?
No,
I think you can start over.
I'm sorry, go ahead.
Sorry, I was just telling Andy I thought he might want to start over.
Is there anything, Andy, that jumps out at you that we need to that we would throw out on the table and kind of discuss that would be a big change or something that maybe we didn't catch? Or
No, not really so much. And the idea, of course, is that the sheriff and the sheriff's administration come up with the rules that the deputies will follow, and all the employees of the sheriff's office. And there have been some substantial changes to a few of the policies, such as domestics, things like that really have just changed, that been updated to reflect some of the changes over the past few years with regards to laws and procedures and things like that. So while there are some significant changes, I don't think there's anything from a disciplinary standpoint that really would be anything that anyone would have any concern over or questions about. It really is just going to come down to, if there's a violation of those things that would go beyond the normal disciplinary things that we would be brought to the merit board before hearing, then those would be the things that would be followed. So I would say there's been some substantial changes in a few firearms policy, the domestic violence pursuits, some things like that are hot button topics, but nothing that I think would raise any eyebrows or anything at all. It's all very consistent. I went to a lengthy training on some of these things and have pulled from a lot of other resources to put them together.
And I think it'll make it a lot easier in the future, because the policies that we've had have been kind of scattered around. We'll be able to, anytime we update them, and they should be reviewed every year, we'll have back copies from, 2020, 2021 to be able to go back and see what they were if, we're involved in some type of civil action as well.
What about the pit maneuver? Are we going to allow the pit maneuver?
That just only on Friday nights when Fish is out.
and merit board gets to use that as well, right?
For him, yes.
Yeah, for Fish. All right. No, I'm fine with that. I like I said, I didn't have a time to really detail review it, but I would assume, trust what you guys are doing. So
All right. Sheena, do you have anything you want to add to that? Did you get a chance to look at those?
I don't even think
Bill?
I got a copy of them, but I think Bill was taking care of it. So
Okay, okay. All right. Okay, so you want a motion today then to start the rules as of today, May 20th, 2020?
Yeah.
Is that right?
Yes.
Okay.
hey, Jim, if you're going to do that, will you do a roll call vote, please?
Sure, we'll do that.
Okay.
Yeah. So do we want to take a motion first and then those that accept it? I'll take a motion to accept the new SOPs for the sheriff's rules and the merit rules starting May 20th, 2020. Have a second on that?
I'll second that.
Okay, we have a second. Let's go person by person. Jim Higdon, yes. Josh McCarty,
yes.
Angie Schreider,
Yes.
Megan Zabrowski,
Yes.
Bob Smith.
Just hit the one button, Bob. Just
Just
Or-
text us. Just text us. I'm
Can
gonna
he
see if
just, can he text the sheriff and just say yes? Is that okay? Does that work, Santa?
You could probably put it in the chat box down at the bottom too.
Yeah, I was thinking the chat box. I was looking to see if he was on there. I mean, if it passes 4-0, you're fine.
Okay,
So I would just leave it like that. I get it.
All right.
I don't. I just
that's fine.
where
Okay, thanks. All right. So the vote passes 4-0. So we'll adopt the new sheriff's rule, SOPs and merit board rules starting May 20th, 2020. And Andy, thanks a lot for your help on this. I know you went through a lot of time and effort on this, and you and the sheriff both. You both deserve applaud for that. Appreciate it.
Andy, did you have a review? I think you did when we talked about this in a prior meeting. Did you have a review committee within some of the officers and?
Yeah, so the way we did it was we actually divided all the policies up into groups and sent those out to have them viewed by members of the agency that it affects every day, and have them make their recommendations. And then when those came in, we then got together and discussed anything that stood out as an administrative group, and then adjusted it from there. And then I went and put those in a more consistent format and got everything locked down and tidied up. But yeah, a lot of credit does go to the members of the department too for having input. We consult, for example, the firearms policy. We had our firearms instructors take a look at that and put input into that and things like that. And they deserve a lot of credit for that too. The group
Okay.
effort for that.
Great.
Now, will we be getting a copy of those, the official copy of those? Do I need to sign anything on that, Sheriff?
I had it set up that you guys could sign it, since I was told that that's not a legal requirement. What we'll do is we'll have it as maybe an appendix onto the document. I'll send the final revision. Bill Barrett wanted to review a few more that we could then update. So today would be the official adoption date, and then kind of as needed, we may make some fine tuning from this point on. And when that happens, I'll shoot that back out to everybody. But basically, we'll figure out some sort of appendix to do a merit board signature group, and then, but it won't be part of the normal documentation because that will be updated as needed.
Right. Yeah, I think it'd be important to have the merit board members' signatures on there so you'll know, who was there when they were approved. So, okay. Any other questions concerning the SOPs? Okay. If not, the next agenda is the promotions. Can't hear you, Sheriff.
You're on mute.
There we go. Sorry about that. We will be working with the promotional company. We've signed the contract or waiting. We did get it signed. So we just need to get that out to them, and the questions and everything will be, put together. We'll get it out to you guys. The dates still hold true to what we sent out earlier. I don't have those right now in front of me, but we're moving forward on it. We'll keep you guys updated on it. We were waiting on these policies so we could get them out and the guys can start studying them.
Okay. I think the dates are October 27th and 28th, if I'm not mistaken.
I
Does
think
that sound right?
Yeah, I've got the dates are, the announcement will be August 1st, 2020, the announcement of the promotion process.
Okay.
Ending signups on August 15th, so 2 weeks for eligible people to sign up. And then there'll be some meetings scheduled after that with the company. But yeah, that's what we had. The October dates is what we had for the.
We just didn't have times yet. I think we're kind of waiting on see how many guys
Correct.
sign up for promotions, and we'll work on the times at that time. Maybe by the August meeting, because you said the cutoff's August 15th, so we should know by our next meeting how many people have signed up, for the promotion list.
Correct.
Okay, sounds good. Okay, anything else? Any old business, Sheriff?
I think that's all we got. Hopefully can meet in person next time and this gets slowed down. Staff and everybody's doing a great job. I appreciate Andy and everybody getting the policies together. That was some interesting reading the last few nights. But I think we're making forward progress, and I think you'll see a difference in this next promotional process as well.
Okay, how are things going in the jail? They getting better?
It is Thursday of next week, the 26th. I believe they'll all be off the quarantine unless we have any other new cases that pop up.
Okay.
Are you the only one that within the state that's tested everyone?
To the extent, yes. Everybody in the jail, employees, yes, we are.
Gotcha. What the Sheriff's Association and other sheriffs and jails think about that?
Well, I think there's mixed emotions, but it's easy, and I think some of them want to throw a goose egg up quite a bit, or if you've got a county in northern Indiana that's not opened up yet because they've extended everything and they throw one up, I think that's a problem. I don't think you're doing your people, your employees, or your citizens any good. You can just keep releasing people all day long. Most of them were asymptomatic. We had 4 inmates that showed signs. So, and it's kind of the same way with our employees. Out of the 8, maybe 2 jailers showed signs or had temperatures. One merit deputy had some issues for just a short period of time, but they got through it. But I think it was something that we needed to do because half these people probably still live at home. That's in the jail. They go home to their elderly parents or kids, and then they give it to them.
Yeah, that's true. Okay, anything else? Any questions from the mayor board for the sheriff or for Andy? I would ask if the audience has any questions, but since we don't have an audience today, we'll forget that one. So with that, I'll take a motion to
Make a motion to adjourn.
Yeah, and the next, just real quick, the next meeting is August 19th. Hopefully we can, be at the jail for the meeting. So we'll see how it plays out. Okay, thanks everybody for doing this. Again, let's take a vote on the adjournment, everybody. I can see your hands. There you go. I got this
Can't
3.
see mine. I'm lazy my left one.
I can see it, Angie.
It's the left one, Jim. It don't count.
Okay. Okay, so it passes 4-0. So we'll see everybody on August the 19th. Thanks again, everybody, for doing this. Appreciate it.
Bye, guys.
Thanks. Take care, guys.